Welcome back to Talk Tickers. This is the show where we strip mine the earnings call so you don't have to.
We do the heavy lifting for sure.
Exactly. We aren't here for the fluff. We are here for the alpha.
Right.
We take that massive stack of SEC filings, the raw transcripts, the analyst notes, and we distill it all down into a single shot of espresso for you.
A very caffeinated shot today, I'd say.
Oh, absolutely. I'm your host, and today we are looking into a deep dive on a company that just pulled a rabbit out of a hat. Or, maybe more like a vintage hand-knit sweater out of a hat.
Yeah, I'd say it's definitely more of a vintage sweater situation.
Yeah.
But a very, very expensive one.
Right. So today is Friday, February 20, 2026.
Yep.
And we're looking back at the call from yesterday morning, Thursday, February 19th.
The Etsy call. Ticker symbol ETS.
Ticker ETS. And let me tell you, the vibe check on this one is, well, it's confusing.
Confusing is definitely the polite word for it.
Because if you are just a casual observer, right, you pull up your brokerage app, you look at the headlines, and you see a miss.
You see the
Right.
top line miss, yeah.
You see guidance guided down. You see a business that is arguably shrinking in real time.
If you just glanced at those headline numbers, you'd think the stock would be down 10% at the open.
Easily.
They missed on revenue. They guided Q1 down. The macro environment out there is still barely lukewarm for consumer discretionary.
Barely lukewarm is generous.
Right. And yet
the stock absolutely ripped.
it tore higher.
We are talking about a classic bad news is good news print. Or maybe, to be more accurate, a strategic pivot, completely overriding a revenue miss.
The market completely looked past the top line.
They really did. The stock closed yesterday at $48.14. That is up 9.28%.
A gain of over $4 a share in a single trading session.
And it was even higher pre-market, right?
Oh, yeah. At one point in the pre-market, it was up nearly 20%.
Insane.
The volume was just completely insane. Over 13.8 million shares traded.
Compared to what normally?
Their average is about 5.7 million. So we are talking massive institutional rotation. The market was so incredibly hungry for this specific narrative. It was a major liquidity event.
And the implied volatility crush was real, too. The historical average drop post-print is around 31%, so seeing it hold a 9% gain is a massive statement.
It's a huge statement.
So here is the hook for today's deep dive. How does a company miss on revenue, tell us that the next quarter is going to shrink, and still get a standing ovation from Wall Street?
It's the magic trick of the quarter.
It really is. And the answer lies in a massive $1.2 billion divestiture and a new buzzword that management must have dropped about 50 times during the call.
Agentic commerce.
Agentic commerce. We will get into that.
Sure.
It's the pivot from growth at all costs to pure profitability in AI.
It's a fascinating case study. It's really a masterclass in corporate storytelling and balance sheet surgery.
Balance sheet surgery. I like that.
Because it's essentially an admission that the whole conglomerate strategy they were running, it failed.
All right, the House of Brands.
The House of Brands failed, and now they are just doubling down on the core moat.
Okay, let's unpack all of this. We have a lot of ground to cover. We're going to look at the numbers, the sale of Depop, the core turnaround plan from the brand new CEO, and this futuristic agentic stuff.
Lots to get through.
But first, let's hit the headline numbers. Fast and furious. What actually happened in the print? Give us the scoreboard.
All right, let's look at the actual scoreboard. GAAP diluted EPS came in at 92 cents.
92 cents.
The consensus estimate on the street was 85 cents, so that's a really solid beat.
Yeah, beating earnings by about 8%.
Exactly, and that tells you a lot right out of the gate. It tells you that despite all the top-line pressure they are facing, they are managing their expenses incredibly well.
Okay, so they are making money. That's good. I mean, in this specific market environment, profitability is absolute king.
They are definitely making money. But on the top line, revenue was $881.6 million.
And the street was looking for what?
The street was looking for $884.9 million.
So a miss.
A slight miss, down about 0.4% against expectations.
Right.
It's not an absolute disaster by any stretch, but it clearly shows that the consumer is still hesitant to open their wallets for non-essentials.
And what about the gross merchandise sales? The GMS? Because To me, that's the actual lifeblood of any marketplace business model. That's the total value of all the goods sold across the platform.
Right. GMS came in at $3.6 billion.
$3.6 billion.
Now, here's where you really have to be careful with the year-over-year comparisons, because remember, they sold Reverb last year.
Right, the guitar and instrument marketplace.
Exactly. So if you exclude Reverb to get an apples-to-apples number, consolidated GMS was actually up 2.4%.
Okay.
But if you just look at the raw print, the as-reported number, it's down 3.8%.
See, it's always so messy when you're shedding assets like that.
Yeah.
The year-over-year comps look terrible on the surface unless you actually sit down and do the math.
They do. But honestly, the number that really matters here, the one that had all the institutional investors salivating yesterday, was the margins.
Let's hear it.
Adjusted EBITDA came in at $222.5 million.
Which translates to what margin?
That is a 25.2% margin.
Wow.
And the take rate, which is the percentage of every single sale that Etsy actually keeps for itself, that is up to 24.5%.
24.5. That is massive.
It is a 170 basis point increase year over year.
That is a seriously hefty take rate. I mean, they are keeping nearly a quarter of every single dollar that flows through the platform.
They are. It is a very, very profitable machine when you look at those unit economics.
Because if you think about typical retail margins, right? Target, Walmart, they are in the low single digits on a good day.
Exactly. And then you think about high-growth tech companies, and they're often running negative margins for years.
Burning cash to acquire users.
Right. But Etsy is sitting in this rare sweet spot where they have software-like margins on physical goods commerce.
But frankly, the immediate catalyst for the stock popping nearly 10% wasn't just the EPS beat. It wasn't even that incredible take rate.
No, it wasn't the operating metrics at all.
It was the portfolio surgery.
The surgery. Let's talk about the real news. The actual market mover of the day. They're selling Depop.
They're selling Depop to eBay. This is huge news. I feel like they just bought Depop not that long ago. It was supposed to be their big gateway to Gen Z.
It really feels that way, doesn't it? It hasn't been that long in corporate years. But they have entered into a definitive agreement to sell Depop to eBay for $1.2 billion in cash.
Cash. Not stock, not some complicated earnout structure over 5 years. Cold, hard cash.
Correct. And that right there is exactly why you saw that implied volatility crush. The uncertainty is just completely gone.
Boom, check is in the mail.
Exactly. Investors looked right past the revenue miss and focused entirely on two things. Number one, the massive capital injection of $1.2 billion. And number two, the margin cleanup that comes inherently with getting Depop off the books.
So let's deep dive into this deal. This is segment 1 of our analysis today. The strategic decomplication.
I like that term, decomplication.
It sounds like a slick corporate euphemism for we made a giant mistake at the top of the market and now we are fixing it.
It's a bit of that, for sure. But it's also just highly rational capital allocation given the current environment. The deal is expected to close in Q2 of 2026.
So pretty soon, next quarter.
Very soon. And the price tag is that $1.2 billion in cash. Now, we need to help everyone understand the why here, because on the surface, to a lot of people, Depop is the cool Gen Z fashion resale platform.
Right.
It's growing. It's culturally relevant. Why sell the cool kid? Why sell your access to the future core demographic?
It all comes down to the profitability angle. Lanny Baker, the CFO, was very clear about this on the call. He basically just opened the kimono on the unit economics of the subsidiary.
He laid it all out.
Yes, Depop generated $1.1 billion in GMS and $187 million in revenue for the full year of 2025.
Those are decent top-line numbers for a niche platform.
Right. It's a billion-dollar platform in terms of volume.
But this is a massive, but it was a huge drag on the consolidated bottom line.
How bad was it?
Well, Depop has a significantly lower take rate than the core Etsy marketplace. And much more importantly, it had negative adjusted EBITDA margins.
Negative.
Negative. It was basically losing money on every transaction, effectively, once you account for the operating costs.
Ah, there it is. Profitless growth, the absolute cardinal sin of the post-2021 zero interest rate era.
Exactly. The market doesn't reward that anymore. In 2025, Depop cost the consolidated business 80 basis points on the take rate.
Wow.
And a whopping 350 basis points on EBITDA margins.
Wait, let me just pause you right there. 350 basis points. That is 3.5%.
Yep.
So if they hadn't owned Depop at all last year, Their EBITDA margin would be almost 29% instead of 25%.
Precisely. That is the math that Wall Street was doing yesterday morning. By selling Depop, Etsy instantly becomes a significantly more profitable enterprise on a percentage basis.
Just by subtraction.
Just by subtraction. You completely remove the drag. You're trading a growth at all costs asset for cold, hard cash to fortify the balance sheet.
It's a move from offense to defense.
Or perhaps you could look at it as a move to a much more focused offense on their core product.
It's an equity story cleanup. I absolutely love that phrase. It makes the spreadsheet look so much cleaner for the analysts. But there is a real human element here that we have to touch on.
The management dynamic.
Right. The new CEO, Kruti Patel-Goyle. She is in such a weird spot with this announcement, isn't she?
It's a truly fascinating dynamic. Kruti has been the CEO of Etsy overall for exactly 50 days.
50 days.
But before she got the top job, she was the CEO of Depop.
She was the one actually running the company they're now offloading.
Right. She was the one in the trenches driving that top-line growth. So on the earnings call, she framed the whole thing as a bittersweet moment.
You could really hear it in her voice during the prepared remarks.
You really could. She emphasized heavily that she is incredibly proud of what the Depop team built over there. She noted that it's a highly differentiated brand with a uniquely strong community.
But she also had to admit out loud to investors that it needs way more investment to scale properly.
Yes. She explicitly said that eBay has the resources to heavily invest in the circular economy that Depop needs to get to the next level.
Because eBay has the physical infrastructure.
Exactly. eBay has the logistics network. They have the massive authentication centers for sneakers and luxury goods. They have the negotiated shipping networks.
And Etsy doesn't.
Etsy is fundamentally a make-on-demand or ship-from-home platform. They don't have warehouses. They don't authenticate vintage teas.
So it's almost like management admitting, we love this child, but we just can't afford to send them to the Ivy League college they deserve. So we're sending them to live with rich Uncle eBay.
Rich Uncle eBay. I really like that. And let's be fair, eBay has been desperately trying to crack that Gen Z fashion market for a decade, so this makes a ton of strategic sense for them too.
It's a win-win on paper.
But for Etsy, this is purely about focus. And of course, it's about the cash.
The cash is so significant. Lanny Baker teased the capital allocation strategy a bit on the call.
He dropped some big hints.
He said the proceeds will be used for general corporate purposes. And this is the magic word, buybacks.
Buybacks. Absolute music to my ears in this macro environment.
They already have $1.8 billion in cash and short-term investment just sitting on the balance sheet right now.
Earning interest.
Right. You had this $1.2 billion check from eBay that clears in Q2, and you were looking at a $3 billion war chest.
That is massive relative to their current market cap. We are talking about a company that is worth roughly $7 billion, depending on how it's trading today.
So almost half the company's value is in cash.
Having nearly half your market cap in highly accessible liquidity is almost unheard of in the retail sector right now.
It gives them just incredible strategic flexibility. They can go out and retire a huge chunk of the float, or they can weather a serious, protracted economic storm if the consumer really rolls over.
Exactly. It puts a very hard floor under the stock price, which is a big part of why we saw that huge rally.
The downside is capped by the cash.
You are no longer betting on whether they can magically grow 20% year over year in a tough economy. You are basically betting on a value stock that happens to own a massive growing cash pile.
So they sold the kids to save the house. Now let's actually talk about the house. This brings us to deep dive segment 2, the core turnaround.
The main event.
They call this project Etsy Prime internally. Actually, I just made that up, but they really should call it that.
They absolutely should. But the official corporate narrative they went with is a deep diagnostic.
Kruti is 50 days in. She clearly didn't waste any time. She conducted this deep diagnostic of the entire business from top to bottom.
And her findings were brutally honest.
What did she actually find? Because frankly, using Etsy has felt a little, dusty lately.
Dusty is a really good way to put it. Or maybe cluttered is more accurate. And I think the market really appreciated her honesty. First, she found that the core differentiation is actually still there.
Meaning people still think of it as a unique place.
Right. People still think Etsy is special,
Right.
but the perception of that differentiation has really softened over the last few years.
Softened meaning what exactly? Like, It's getting harder to actually find the cool stuff among all the junk.
Exactly that. Buyers are just totally overwhelmed by the sheer scale of the platform now. There's so much stuff on the site that it's incredibly hard to find the truly special, handmade items.
It's the paradox of choice.
It is. You go on there and search for a custom leather wallet, and you get 50,000 results. And honestly, half of them look like drop-shipped generic goods from overseas factories.
Right. The sea of sameness. I absolutely hate that. If I go to Etsy, I want a hand-stitched leather wallet from a guy in Montana, not something I can buy on Temu for half the price with free shipping.
Correct. And she openly acknowledged that specific pain point. She also highlighted a really concerning demographic issue.
The aging buyer base.
Yes. Etsy's core buyer base is aging. The older cohorts are continuing to grow, which is fine, but the younger ones aren't replacing them fast enough.
Which is why they bought Depop in the first place.
Exactly the irony. But for the core site, she called this a presence gap. She noted it's not that Gen Z inherently dislikes Etsy as a brand, it's that Etsy simply isn't showing up where Gen Z hangs out online.
They aren't natively on the For You page on TikTok enough.
Right.
They aren't deeply integrated into the social commerce flows where discovery actually happens today.
Precisely. And the third major finding from her diagnostic was all about engagement.
What was the issue there?
She said they got really, really good at closing the transaction, making the checkout process fast, frictionless, easy.
The Amazonification of checkout.
Right. But they got very bad at giving people an emotional or compelling reason to actually come back a week later.
They basically became a vending machine instead of a destination.
That's the perfect analogy. You go in, you get your item, you leave. So the new operational overhaul she announced is specifically designed to fix that vending machine problem.
Outside.
She announced that they have completely moved away from traditional functional silos.
Oh boy, corporate speak alert.
Yeah.
Breaking down silos. Drink.
I know it sounds like MBA bingo, but it actually really matters here. They used to have a totally separate product team, an engineering team, a marketing team.
Like most companies.
Right. Now they're entirely organizing the company around customer outcomes. They have formally consolidated product and engineering into one single unit.
That should speed up feature releases.
And they unified trust and safety with customer support.
Now that specific trust and safety move is super interesting to me. Usually, those are totally separate divisions in tech. Why combine them now?
It makes perfect sense if you think about the actual user experience on a marketplace. If I have a problem with an order, say I think it's a counterfeit item or it arrived broken, that's fundamentally a support issue and a trust issue simultaneously.
Right. The customer doesn't care about internal department boundaries.
Exactly. Putting them under one unified leader means much faster resolution for the buyer. It cuts through the internal bureaucracy. The entire goal here is speed. Faster execution across the board.
Okay, so she rearranged the corporate deck chairs. That's great.
Yeah.
But is the ship actually turning around? Do we have any tangible green shoots in the data?
We actually do. And this is the other big reason the stock held up so well yesterday. For the very first time in 4 years, U.S. buyer GMS showed positive growth.
Positive 0.3%. It's tiny.
It is microscopically tiny, but it is a positive number.
Fair enough.
It's a vital sign of life. After literally years of negative comps ever since the COVID hangover started, seeing a plus sign in front of that specific U.S. buyer number is huge psychologically for the analyst community.
It means the bleeding has finally stopped in their most important market.
Exactly. And what about the app usage? That was another bright spot.
Let's look at the app. App GMS grew 6.6% in Q4.
That's solid.
And the app now drives 46% of total GMS, which is up 5 full percentage points from where it was in 2023. Plus, homepage clicks are up 14%.
Now, that's actually really important because app users are inherently stickier, right?
Much stickier. The lifetime value, the LTV of an app user, is significantly higher than a web user.
Because they have the icon on their home screen.
Exactly. If you have the app physically installed on your phone, you are far more likely to just passively browse when you're bored on the couch. You start to treat it a little more like Instagram or Pinterest, not just a transactional store.
And we saw that retention overall is showing real signs of life, too.
Yes, the active buyer decline is officially flattening out.
Oh.
They added 6.8 million brand new buyers in the quarter, and they reactivated 10.4 million lapsed buyers.
10.4 million reactivations. That's a massive amount of people suddenly remembering, oh yeah, Etsy exists, I should buy a gift there.
Right. So total gross ads were 17.2 million, growing for the very first time in 2 solid years. So even though the total revenue missed by a hair, the underlying health of the ecosystem, the actual user behavior at the bottom of the funnel is definitely stabilizing.
Okay, so the patient is stable in the ICU. But how do they get the patient to get up and run a marathon?
That is the multi-billion-dollar question.
Which brings us to Deep Dive Segment 3, the agentic frontier. This was absolutely the shiny object of the entire earnings call.
Oh, it was blindingly shiny. I honestly think if you took a shot every single time management said the word agentic, you wouldn't have made it to the Q&A session.
You'd be on the floor. Agentic commerce. It sounds like the title of a sci-fi movie.
It does.
What exactly are they talking about here? Because usually when traditional retail companies talk about AI on these calls, they just mean a slightly better customer service chatbot that helps you find your FedEx tracking number.
Right, the basic stuff. This is totally different. Agentic refers to autonomous AI agents, not just a passive chatbot that answers simple text questions, but an AI that can actually take complex actions on your behalf across the web.
Acting as an agent for you.
Exactly. The core thesis they pitched is that Etsy isn't just sitting around waiting for generative AI to disrupt traditional search engines. They are actively plugging their inventory directly into these new AI brains.
They announced some pretty big partnerships to make that happen, right?
They did. They have formal partnerships in place now with Microsoft Copilot, with Google, and they announced a specific agentic payments agreement with Stripe. Okay, let's break that down for the listener. What does that actually look like for a normal user trying to buy something?
Imagine you are sitting at your desk, typing into ChatGPT or Microsoft Copilot. You type, "I need a highly unique 30th birthday gift for my sister. She loves astronomy and indoor gardening, but she absolutely hates clutter."
Okay, that is a very specific, nuanced query.
Right. A standard legacy search engine like Google or Amazon really struggles with that kind of complex prompt. Amazon just looks at the keywords and gives you a telescope or a generic bag of potting soil.
Which isn't a great gift.
No. But the AI agent can parse the actual human intent behind that sentence. It understands how astronomy, gardening, and anti-clutter intersect. It can then surface actual highly rated Etsy listings.
Like what?
Maybe it finds a hand-painted, small ceramic planter that features constellation maps on it. Perfect for a succulent, fits on a desk, hits all the criteria.
And with that new Stripe integration they mentioned, the ultimate goal is that you could potentially just buy that planter right there, natively within the chat interface.
That's the holy grail, the instant checkout vision. You never even have to leave the AI chat window. The agent handles the discovery, the filtering, and the final financial transaction seamlessly.
But what's fascinating is the actual hard data they shared on this during the call. They said agentic traffic flowing to Etsy in Q4 was 15 times what it was a year ago.
15 times. That sounds massive on a percentage basis.
It does sound massive.
But we have to be realistic here and ground this. It is still less than 1% of their total overall traffic.
Right.
It's a drop in the ocean right now. It is statistically insignificant for their actual top-line revenue today.
But the quality of that specific traffic.
That's the real key. Management noted that buyers coming specifically from AI interfaces, like clicking through from a ChatGPT prompt, have significantly higher purchase intent and a notably higher average order value, or AOV.
Well, that makes total sense intuitively. If you are having a detailed 10-minute conversation with an AI to track down a very specific, perfect thing, you are probably ready to pull out your credit card. You aren't just doom-scrolling window shopping.
Exactly. You are on a mission. And they are seeing what they are calling flow-through.
Flow-through.
Yes. Meaning people might start the chat and the discovery phase on an AI agent, but they still actively choose to click through and come to the actual Etsy website to finalize the purchase.
Why not just buy it in the chat?
Because these are fundamentally high consideration items. They have emotional weight.
Right. Like if I'm buying a 12-pack of AA batteries, I don't need to see the seller's profile. I don't care about their personal journey. I just want the batteries at my door tomorrow morning.
Exactly. But if I'm dropping $200 on a custom monogrammed leather bag for an anniversary, I want to see the photos. I want to read the reviews from other buyers. I want to click on the About the Maker section.
You want to know if the leather is ethically sourced, who made it, the whole vibe?
Precisely. The transaction requires human trust. And that leads directly to what I think is the most interesting part of their whole thesis, the unstructured data moat.
Yes, this was the most intellectual, frankly brilliant part of the bull case they laid out. Management essentially argued that AI agents might actually inherently prefer Etsy over Amazon for complex queries.
This is the absolute crux of the long-term argument for the stock. Think about Amazon. Amazon is entirely built on commodities.
Right.
It's built on UPC barcodes. It has perfectly structured data. The database says this is the toaster, it is black, it draws 800 watts, it ships in 2 days.
It's extremely database friendly, but very rigid.
Right. But LLMs, large language models, the brains behind these AI agents, they actually thrive on unstructured data.
Because they are language models.
Exactly. They thrive on human stories, sentiment analysis, nuanced paragraph descriptions. They fundamentally want rich text, not drop-down checkboxes.
And Etsy is just overflowing with that exact type of data. Almost every single listing is a little narrative story written by a passionate human being.
Exactly. Etsy has messy, unique, totally unstructured inventory. The new CEO paraphrased this beautifully on the call.
What did she say?
She said that AI helps sellers' items starkly stand out against the sea of impersonal, undifferentiated, mass-produced goods.
That is a great quote. So the core argument is basically, in a future world completely dominated by AI search efficiency, the messy human story actually becomes the premium, scarce asset.
Yes.
The inherent messiness of Etsy's catalog is exactly what makes it so incredibly valuable to an AI that is training on nuance and sentiment.
That is the bet they are making. They are betting heavily that AI will serve as the ultimate personalized curator for their chaotic inventory. If you have 100 million items on your platform and literally no two are exactly alike, a standard keyword search is just terrible.
It breaks down completely.
But semantic search, an AI agent search, it's perfect. It understands the vibe. It finds the absolute needle in the haystack for you.
And to their credit, they did directly address the bear case on the call, too. Because the major bear case for all platforms right now is that AI agents will just completely bypass them and commoditize the entire internet.
Right. The existential fear is that the AI just finds the cheapest version of the item anywhere on the web, executes the buy order via an API, and the marketplace itself just becomes a dumb, invisible pipe.
A race to the bottom on price.
But management powerfully pushed back on that. They argued that for meaningful commerce gifts, weddings, art, dealed, the human connection is an inextricable part of the value proposition itself.
You aren't just buying the physical object.
Exactly. You are buying the feeling of supporting an independent artist. You are buying the story. AI can certainly surface that story faster, but the final transaction and the vital component of trust still have to happen within the platform's walled garden.
It's a very compelling narrative to sell to Wall Street. It elegantly turns their historically biggest weakness, which is their messy, unorganized, hard-to-search inventory, into their single biggest strength in the new age of AI.
It really does. Now, whether it actually works at scale and drives revenue remains to be seen over the next few years. But right now, today, it gives investors a reason to dream.
And in this market environment, a dream combined with massive free cash flow is a very powerful drug.
It absolutely is.
Speaking of cash flow, we should probably get back to reality for a second here. Let's move to Deep Dive Segment 4, Investor Context. Because despite all these grand dreams of robots doing our holiday shopping for us, the actual financial guidance they gave for Q1 was, well, let's call it heavily sandbagged.
It was undeniably soft. Q1 guidance for total GMS is coming in between $2.38 billion and $2.43 billion.
Which means what for growth?
That implies a slight decline or, at best, very low single-digit growth, depending on exactly how you model the foreign exchange rates.
So the top-line metric, GMS, is essentially going down in Q1.
Very likely down slightly year over year, yes.
Yep. So why on earth did the stock rally almost 10%? Because generally speaking, if a CEO gets on a call and tells me, hey guys, my core business is going to shrink next quarter, I usually don't rush out to buy their stock.
No, you usually sell first and ask questions later. But this is all about the projected trajectory. Management promised, and frankly, this is a very bold promise to make to the street, they promised positive year-over-year comps in each and every quarter of 2026 for the full year.
Wait, I need to clarify that. Did they say positive comps in each individual quarter?
Yep.
But you just said Q1 looks down.
Sorry, let me be very precise. They expect the full aggregated year to show modest growth, and they expect the actual growth rate to sequentially improve as the year goes on. Lanny Baker, the CFO, warned everyone that the new product and marketing initiatives, what they call their flywheel, these things take real time to compound.
So Q1 is the absolute bottom.
Exactly. Q1 is the trough.
Ah, the classic trough year narrative. Investors absolutely love trying to catch a falling knife right at the perceived bottom.
They do. The narrative they successfully spun is, look, this right now is the bottom. Q1 is the messy, noisy quarter where we finalize selling Depop, We eat the restructuring costs and we reset the baseline. But from Q2 onwards, it's a steady climb up and to the right.
And crucially, they have the massive buybacks to artificially support the stock price while we all wait for that growth to materialize.
Exactly. They quietly repurchased $133 million worth of stock in Q4 alone.
And that was before the eBay money.
Right. With the new cash coming in, that buyback pace is highly likely to accelerate dramatically. And let's not forget the core profitability metrics. Q1 adjusted EBITDA margin is officially guided to a range of 28 to 30%.
30% operating margins. That is literally software-level profitability for a company that ships physical wooden tables and knitted scarves.
It is phenomenal. So the math is, even if top-line growth is stagnant or slow, the actual cash yield generating to the bottom line is incredibly high.
And they did openly acknowledge the macro headwinds, right? They didn't pretend everything is perfect.
No, they were realistic. They admitted there is ongoing heavy pressure on consumer discretionary spending.
Yeah, I mean, nobody strictly needs a $40 hand-carved wooden spoon when grocery inflation is still biting them every week.
Exactly right. But they explicitly stated that they assumed macro stability in their financial outlook.
Meaning no further deterioration.
Right. Not expecting the economy to magically improve, just expecting it to stay exactly as it is. So theoretically, if the macroeconomy actually does improve and rate cuts finally stimulate spending, there is massive upside to this guidance.
Okay, let me summarize the setup here. We have a highly profitable core business, a mountain of cash coming in from a divestiture, a new CEO executing a turnaround story, and a futuristic AI narrative that is just crazy enough to actually work.
That perfectly sums up the bull thesis.
Which brings us to my absolute favorite part of the show. The segment where we throw caution entirely to the wind and channel our inner hedge fund degenerates for a few minutes.
Please, let's try to keep the legal team somewhat happy today.
Of course, of course. This is officially This is not financial advice segment. We are definitely not your financial advisors. This entire conversation is for entertainment purposes only. Please go do your own due diligence. If you execute a trade and lose all your money, do not tweet at us angrily.
Yes, ideally just don't lose your money in the first place. But go ahead, lay out the pitch. What's the outrageous trade idea?
I call this specific trade setup the agentic gamma squeeze and the cash cannon.
The cash cannon. That sounds incredibly dangerous.
Oh, it is. But here's the setup. Etsy is arguably the most natively AI-ready e-commerce stock in the entire market right now, but absolutely nobody is pricing it as an AI stock yet.
True.
Right now, today, it is priced by the market as a distressed, slow-growth consumer discretionary stock. It's basically priced like a mall retailer that's slowly bleeding out.
It's definitely trading at a very, very reasonable multiple compared to its historical averages. You're looking at maybe 15 times forward EBITDA right now.
Exactly. But here is the massive catalyst looming on the horizon. The eBay deal officially closes in Q2. That is a $1.2 billion check clearing the bank.
Yep.
Plus, they already have $1.8 billion sitting on hand. That equals $3 billion in pure, unadulterated liquidity on a company with a total market cap of what, maybe 6 or 7 billion?
Roughly, yeah. Depending on the daily chop.
So nearly half their entire market capitalization is backed purely by cash.
That is an immense margin of safety.
So here is the outrageous but highly plausible thesis. Step 1. Management looks around and uses that $3 billion combined liquidity to execute a monster buyback.
A tender offer or just open market?
Open market, aggressive. I'm talking about systematically retiring 15 to 20% of the entire public float in a single 12-month period.
That would be historic.
Why would they do it? Because they have literally no other M&A targets right now. They just sold their only major acquisition. They aren't going to go out and buy another platform right now. They're going to them by themselves.
That is a highly plausible capital allocation strategy. Lanny Baker clearly loves buybacks. And with the stock languishing at these depressed multiple levels, retiring shares is massively accretive to EPS.
Exactly. Then comes step 2. The agentic narrative actually catches fire in the mainstream financial press.
The AI tailwind.
The market collectively wakes up and realizes that in a world completely dominated by AI agents, Amazon's data is actually boring. Amazon just sells identical commodities.
Yes.
Etsy, on the other hand, sells the exact unique data points that LLMs are starving for: stories, sentiment, human uniqueness.
So your core bet here is on a massive multiple expansion.
I am betting on a total violent re-rating of the stock. I'm betting on Wall Street moving it from a boring retailer PE ratio to a high-flying tech platform PE ratio. If that narrative shift happens, combined with a share float that is rapidly shrinking by double digits every quarter because of the buybacks, you get an absolute face-ripping squeeze higher.
It's the classic hedge fund pod rationale.
Explain that for the listeners.
It means you are essentially getting paid to wait because of the relentless buyback support underneath the bid. The immediate downside risk is heavily protected by that $3 billion cash floor.
Right.
And while you wait in safety, you basically own a free embedded call option on Etsy, magically becoming the default visual shopping engine for ChatGPT and Gemini.
Exactly. You get the AI upside for free.
Yeah.
So the specific trade structure, I'm looking at going the January 2027 LEAPS.
Deep out of the money calls.
Deep out of the money calls.
Yeah.
Maybe the $80 or $90 strikes. You are buying yourself plenty of time, almost 2 years, for the agentic story to fully play out in the media and for the cash cannon to relentlessly fire into the float.
It's a very bold structural trade. It inherently relies heavily on Kruthi actually executing this messy operational turnaround, and that the whole agentic thing being much more than just earnings called buzzwords.
There's execution risk, absolutely.
But the hard mathematical floor provided by that cash balance is undeniable.
It's a beautifully asymmetric bet. Limited downside, explosive narrative upside. And that's exactly what we look for here.
Just remember to keep grounded, though. Agentic traffic is still less than 1% today. It's a very long, bumpy road from here to there. And if we hit a severe macro recession, nobody is going to step in to buy your EPS.
Details. The stock market ultimately trades on forward-looking stories, and this is a fundamentally great story to tell.
It is undeniably a fascinating story.
All right, let's go ahead and wrap this up. Recap time.
Let's do it. So Etsy essentially sold the kids' Depop to eBay for $1.2 billion in cash. They are refocusing entirely on the parents of the core marketplace.
They have a massive balance sheet-altering cash infusion arriving in Q2.
The core business is finally showing real signs of stabilization. U.S. buyers are growing again, albeit very slowly.
And they're betting the absolute farm on agentic commerce to permanently solve the search and discovery problem that has plagued their massive inventory for years.
Ultimately, the market heavily rewarded focus and profitability over pure revenue growth this quarter.
They certainly did.
But the clock is now loudly ticking on Kruthi. She has to decisively prove that the core marketplace can actually return to real growth, not just manage a flat stabilization.
You can't just cut expenses forever.
Exactly. She can't just cut her way to greatness. Eventually, the platform actually has to sell more handmade items to more people.
That is the ultimate challenge. But for right now, today, the bulls are firmly back in control of the narrative. The chart looks surprisingly clean, the stops are tight, and the AI robots are apparently doing our shopping.
It's a very brave new world out there in retail.
Indeed it is. Which brings me to a final thought for you to chew on this weekend. If AI agents do become the primary way we discover unique goods, who actually owns the customer relationship? Does Etsy own the buyer, or does OpenAI own the buyer?
Oh, that is the existential threat right there. If OpenAI is the interface, Etsy is just a warehouse.
Exactly. Something to think about before you buy those leapies. Anyway, thanks for joining us for this deep dive into Etsy's crazy quarter. We will be back next week with another earnings strip mine. Until then, keep your charts clean and your stops tight. We'll see you on the next print.
Goodbye, everyone. Happy trading.